Hi, good week to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook on the major stock indices. So just to remind you guys that this week will be a shortened week because most of the markets will be closed for Good Friday holiday, pardon me, on this Friday, 15th of April. So as usual, we'll be covering the latest trend bias and key technical levels on the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, as well as the German 40 indices. So before we start, let's take a look at the disclaimer slides first. Okay, so before we go into the technical configuration of the various indices that I tend to share, so let's take a look at the momentum analysis across the globe for the benchmark stock indices from US, Europe, and as well as Asia. So as you could see that last week was precisely every major stock indices across the globe were actually showing negative performance. So what we could say that it started to actually show signs of, in fact, it started to show pullback after 3 to 4 weeks, depending on which market you look at, of upward movement. Okay, especially if you look at the US, the SPX 500 and the Nasdaq 100 has started to show negative performance last week after close to actually 3 weeks of consecutive gains. So what we could see last week, very interestingly, is the underperformers. The one I would say that the weakest among the US indices were actually the Nasdaq 100 as well as the Russell 2000. The Nasdaq 100 dropped by 3.6 -3.6%. The Russell is the worst underperforming index, which is with a loss of -4.6%. And one of the reasons actually attributed to the loss of these two indices is actually due to the nature of their stocks that is inside these indices. The Nasdaq 100 actually consists of a growth company. We talk about tech company. Yeah, even though some of the major tech company has lower leverage, but unfortunately, in terms of sentiment, they're being clustered as a growth benchmark index, where we start to see in the last week, especially last week, the U.S. 10-year Treasury yield actually broke above a key major resistance at 2.55%. It has a weekly close, so that is actually being drawn on the monthly chart. So those who actually followed me on social media, I have a social media account. Uh, Later I'll share you where to find this social media account. I actually tweeted much earlier that we need to keep a lookout for this 2.55%. A break above it could actually start to see underperformance of these growth related stocks as well as small cap stocks, especially small caps. Why? Because small caps they tend to be very highly levered or tend to be more leveraged in terms of their operation to drive bottom line growth. So that actually explains the weak sentiment and or the weak performance that was seen last week on the Russell 2000. So if you go to the Hang Seng Index, the Hang Seng Tech Index, last week performance was slightly better. Or in fact better compared to the US benchmark indices, where the Hang Seng Index is down by -0.76%. The Hang Seng Tech Index performed slightly better than the US tech big tech stock, which is very represented by the Nasdaq 100, down by a lower magnitude of -2.2%. But do be cautious over here is that this is last week performance. So later I share with you all the chart of the Hang Seng Index. In fact, it has started to actually turn weak as well. Why? Because of this ongoing COVID-19 related restriction lockdown on key commercial hubs in China, which is Shanghai. Previously, it was actually supposed to end last week, but if you look at the cases in Shanghai now, actually broke. In fact, it actually more than doubled or twice, even twice. I think 4 or 5 times, much more than the cases where the lockdown was started in the fourth week of March. So it seems to me that we are now entering the stage where there is some short-term fears in China that this lockdown may starts to continue. And also, do not forget over here is that just now, just a while ago, about 2 in the morning, about 9:30 a.m. Singapore time, we see the release of China inflation data, which is which actually rose to actually a 3-month high, which is at around 1.5%, year on year, way above consensus of 1.2%. Okay, so what it means over here is that uh, PBOC may be a bit more cautious in terms of front loading their interest rate cuts, where market participants are just expecting to come this month to actually elevate these rising fears of economic slowdown in China as per I explained earlier, due to the COVID-19 related lockdowns of key commercial hubs like in Shanghai. So to be cautious on the Hang Seng and the Hang Seng Tech Index, so there may be a bit of near-term lackluster performance for this week, even though last week performance was actually better than the US stock indices. Then Nikkei 225 as well, it's been pretty weak as in our expectation, negative 2.46%, and the German DAX index is at negative 1%, negative 1.10%. So overall, right, if you were to look at the difference between I would say that is the rate of change between last week performance and its prior 4 week average, all major indices are actually close negative, are showing signs of an increase in downside momentum. So the one that is increasingly showing signs of, we call it downside momentum, is the Russell 2000, followed by the Nasdaq 100. So now let's take a look at the key component, the 11 S&P sectors performance for last week. So not too bad. At least we do not see, even though last week was a weak performance on the SPX 500, or in fact in general the entire US stock market. So, but however, we still see some pockets of strength. So out of 11 sectors, we have one, two, three, four, five. Five of them are in the green. And what's interesting over here is that we'll be emphasizing is that defensive as well as energy is actually holding the fort for the last 8 weeks, which is continued to do so last week as well. So we start to see healthcare gaining by 3.4%, energy 3.2%, consumer staples and utilities as well as healthcare are, we call it as a defensive sector, where their revenue flows, or their future revenue flow, I would say, that is being perceived as less likely to be damaged by rising US Treasury yield. Okay, long-term US Treasury yield. That means we're talking about, we are now in a situation where we start to see a liquidity tightening condition from the short end to the long end. So that could actually be in fact impacted in terms of corporate borrowings or corporate funding, which that means, i.e., we have a higher cost of operating business, especially those who require borrowings to run their business to maintain their bottom line or revenue growth. Whereas these defensive companies tends to do not have such significant impact by rising borrowing costs. So that's why they've been named as defensive due to the nature of their revenue flow. So all in all, we still do expect this defensive company to continue to outperform the general market, especially in Q2. Right. So now, very quickly, now let's jump into the technical chart. Let me bring you to CMC Next Gen platform. Okay, let's start with the SPX 500 first. So overall, the SPX 500, let us take a look at today's price action, because our how to say, the index that is quoting our platform actually based on the futures pricing, which is actually quoting right now in Asia session. So we start to see today's price action starts to actually goes down below the 200-day moving average over here. So all in all, what we could see is, very interestingly, is they didn't manage to surpass the 4640 level, which is this resistance zone over here. The former swing low of 10 of Jan broken down, tested, and refused to have a break above it. And if I were to draw a Fibo retracement, taking from the all-time high towards the low of 20, yeah, the low of 24th of Feb, it actually stopped at 76.4%. Okay, so we have a bunch of significant elements, Fibo retracement and graphical, that is actually preventing the boost from actually surpassing this 4640 since 2 weeks ago. So what it means over here is that it could actually now starts to see a retracement to actually retrace this this what called this swift rebound that has taken shape since 8th of March. All right, so there could be a retracement or an increased odds of a retracement taking place, given the current price action on the SPX. So all in all, what we could see over here is the RSI still is around the 50% level, but what's interesting over here, it's still holding above this ascending trend line support that is now at 41% level, where previously it started to shape this bullish divergence, where we start to see the RSI shaping higher low after hitting the oversold zone, where price action is still doing lower low at that point in time. So then this occurrence actually happened right before the recovery or the swift rebound that takes shape around 3 to 4 weeks ago. So all in all, what we could see now is this RSI could be coming down towards key corresponding support at the 40% level. So that could actually, in conjunction, it could actually be the graphical support at 4300 level on the SPX. Now let's take a look at the strategy chart to actually pinpoint or zero in more closely to a near-term horizon, because we are now looking for what is to expect for this week. So the 4-hour chart will be a more appropriate chart to actually fine tune the levels for our strategy. So what we could see over here is, in terms of elliott wave, we could actually label the low of 15th of March all the way up to the 29th of March as this completion of this medium-term impulsive uh, wave one up move. And right now we are doing a retracement of this wave one. We can label it at wave two slash. So this retracement tends to actually stop around at 50% to 61.8% level. So what we see over here is, if I can draw the retracement from here for the high, so we have 61.8% close to the graphical 4300 level, and 50% at 4390, which is also a graphical, we call it former graphical resistance, now turns into a support level, which was being supported on the 18th of, pardon me, yeah, on the 19th of March, we actually tested and staged a rebound. So all in all, what we could see right now is, as long as 45.35, which is the near-term resistance, is not being surpassed to the upside in the coming days or 1 2 days, we may see a bit of residual downside momentum to actually take the SPX 500 much lower towards 4390, potentially a maximum at 4300 level, which is the key medium-term pivotal support I set for this week. Then thereafter, we may start to see the start of this impulsive up move, which is, in terms of elliott wave, will be the wave three, to actually take us back up towards 45.35, then at least followed by the swing high area of 46.40 for this week. Okay, so this is the kind of strategy that I have in mind in place. That means we may see a bit of short-term uh, residual or short-term push down first towards 4390, then thereafter 4300 level must hold before we're talking about another potential start of a medium-term impulsive up move taking shape for the SPX 500. So, but nevertheless, if we start to see a 4-hour close below 4300 level, then this will be a concern to us. Really. Why? Because this entire up move over here may not be a recovery move. So what we could see over here is that this move here could be a corrective rebound or a dead cat bounce, where we may start to see the SPX 500 to actually take down much lower than 4140 slash 4110. That means we may start to see there is not definite yet, but there's an increased odds that that another down leg will actually be 20%, a 20% down move to actually break below the low of 24th of February. Not definite, but an increased risk. All right. If that we have a 4-hour close below 4300 level. So in first step, we are looking at this swing low area of 15th of March at 4140 slash 4110 first. Okay, on the SPX 500. Now, quickly to the higher growth beta or higher beta index will be the Nasdaq 100. So let's take a look at Nasdaq 100 on the daily chart. So you look at the Nasdaq 100 on the daily chart, they actually surpassed the 200-day moving average, which is acting as a very stubborn or a stiff resistance for the bulls to actually overcome, which is at 15,280 slash 15,540 over here. And right now, it's coming very close back to the some graphical congestion zone, which is at the 13,900 slash 13,800. So if we do the Fibo retracement over here, okay, it's at 61.8% exactly. All right, a golden ratio. So we see a couple of confluence of we call it elements coming in, acting as a potential support so far at potential support going forward at 13,900, pardon me, slash 13,800. And also the RSI is also coming close to a ascending trend line support. All right, the corresponding support level is around the 41% level, so very close as well. And this trendline support is actually being taken from the former bullish divergence that was seen earlier uh, during the fall in January, all the way down to the fall in March. All right, so very similar price action with the SPX 500. So for the strategy that we have over here is we're still keeping the same elliott wave count as the SPX 500. So right now, that means we're talking about since 2 weeks plus of move is considered as a corrective wave two move. So we're expecting a bit of residual downside movement. That means downside momentum is still pretty intact right now, as long as 14,800 didn't surpass, which is the intermediate resistance, to test at for a test at 13,800. So as long as 13,800 didn't break to the downside, that means there's no 4-hour close below it. Potentially, we could see the start or of the impulsive medium-term impulsive up move wave three, wave three slash. That means we can start to see a recovery wave on the Nasdaq 100 towards at least a retest towards that 200-day moving average and that former swing high, the swing high area of 29th of March at 15,280 slash 15,540. All right. So, but however, a 4-hour close below 13,800, then we now faces the risk to actually indicate that the recent swift rebound from 15th of March all the way up to 30th of March. That means the last last 4 weeks. It's more like a dead cat bounce, and this fall itself over here could be a risk and increase of an impulsive down move. That means we could start to see a multi-month decline of 20% over here. So, but in first step, we are looking for a test first at the 12,970 if we have a 4-hour close below 13,800 level on the Nasdaq 100. So now moving on, next will be the Hong Kong 50 or the Hang Seng Index. So you look at the Hang Seng Index, it's pretty weak today. So what we could see over here in the previous move over here is that this previous move seems to be consolidating in a kind of a expanding wedge range configuration. So all in all, I could see that in this expanding wedge range configuration, we have a series of higher high, but however, the RSI is displaying a bearish divergence by showing lower high. That means indicate to us that this up move here, the momentum is losing, and today's price action actually gapped down and broke below the lower boundary or the expanding wedge support level right now. Okay, it's taking shape right now and slightly above 20,980, which is the swing low area over here of 10 of which is this intermediate graphical congestion support over here before the expanding wedge is being formed as it continued to evolve in the last 1 to 2 weeks over here. So what we could see over here is now there's a risk below 23,380 key medium-term pivotal resistance, which I set for this week. There's a risk for it to do a much more continuation of this down move to at least retrace 61.8% of this last rebound or the recent recovery from 15th of March all the way up to the high of 4th of April. Okay, so if I do the retracement, right? Okay, 61.8% stop at 19,870. So we are looking for at least a down move for this week to actually come close towards 61.8% at 19,870, as long as 23,380 key medium term pivotal resistance holds, because I do not want to tighten the resistance too tight to push it too down, because I do not want to have any whipsaw over here, because there's still a possibility that this could be a failure break to actually for the price action to go up and back into this expanding wedge again. And the top of this expanding wedge is actually at this pivotal resistance, which is at 23,380. That confluence with this former swing low area of 28th of Jan that was actually taken out, that led to that steep decline of 24th of Feb all the way down to 15th of March. All right. So all in all, right, this is a key resistance level to watch, at least from a medium term perspective. That means talking about weekly outlook perspective. So as long as this level holds, there is still a risk for it to actually come down further to actually retest the 61.8% retracement of this of this recent rebound. All right. So however, a 4-hour close above 23,380, then we say that the bulls have started to regain its strength, where we could see a further up move towards this major resistance level at 24,600 slash 25,080. Why is it major? Because this is actually confluencing with the swing high area of 21st of Jan 2020 and the 11th of Feb 2020, that confluence with this very long term or a major descending resistance of this expanding wedge that that I link the highs the current all-time high at 18th of Feb 2020 over here. All-time high at 18 Feb 2021, pardon me, over here. So this is the kind of a long-term descending, we call it expanding wedge resistance that is considered major in nature. Why? Because I connected from your all-time high, and all in all, right, previous rebound didn't manage to surpass this long-term expanding wedge resistance level, now acting as a resistance at 24,600 slash 25,080 level. Okay, now moving on to the Nikkei 225. All right. So going on to the Nikkei 225. Last week the Nikkei 225 we turned neutral because of mixed elements. But however, in the later part of last week, which is on Friday, it actually broke below the neutrality level at 27,000 level, which we now have more evidence of a further down move in the Nikkei 225 index after its failure to stage a proper bullish breakout above this descending trend line resistance. Okay, let me, oh, sorry. Okay, let me, uh, okay, okay. So, from this descending trend line resistance, that is kind of preventing further price up move since 14th of Sep 2021. All right, so this is a failure breakout, and now it's actually acting as a resistance at 28,110, which is so confluence with this former range support linking the low of 20th of August, 6th of October, and as well as 1st of December, and it did a bearish breakdown on the 11th of February. Okay, so all in all, now we may start to see a risk of this Nikkei 225 or the Japan 225 to kind of retest this support level at 25,700. So what's 25,700? Which is also this former swing high of 10th of March. And also, if we do the retracement, it's also confluence with the golden ratio of 61, very close to 61.8%, but it's at 76.4% in terms of the graphical support. So we have a feeble retracement of 76.4 and a graphical support zone at 25,700 level. Okay, and if you look at the RSI still has a bit of room more to actually push down further to retest the key corresponding support at the 39% level. All right. So now on the 4-hour chart to fine tune our strategy for this week is I'll be using 28,110 as my key medium term pivotal support set for this week, and I will flip to a bearish bias to actually look for a further push down towards 25,700 level. Okay, so nevertheless, if we start to see a 4-hour close above the 8,110, then what we could see is that the bearish scenario will be invalidated to see at least a push up, a first step towards to retest the 5th of Jan 2022 swing high area at 29,390. Okay, then now, lastly will be the European index, the German 40 index. So what we could see this German 40 index over here is ever since 2 weeks ago, it actually hit close to the 15,030 level. So why this level is pretty interesting is that we see a number of elements confluencing acting as a resistance. Firstly is this former range support level that is depending on how you draw it from the swing lows of 4th of October all the way up to 26th of Jan 2022, and there's this ascending range support level which is also confluence very close at 15,030 level, also draw from the low of 6th of October 2021. And if you were to do a retracement from the top, from the current all-time high, which is 18th of November, towards the low of 7th of November, is actually close to the 61.8% as well. Okay, so all right, then if you look at the RSI seems to have a bit of room more to actually come down to actually retest the this key pullback support level, key corresponding pullback support level, which is actually close to the 36% level. So there's a risk that this German 40 index may actually shape another down move here towards 13,600 level again. Okay, so over here was 10,600 level. If I were to draw, okay, let me remove this. If I draw a feeble retracement, taking the low of 7th of March towards the high of 29th of March is at the 61.8% level, which is close to the 13,600 level. All right. So now to the strategy chart we have this week. So given that we are now middle of nowhere, right? Because last week we have a key support level at 13,900. They're looking for a push up to retest that, former range support now turns into a key pullback resistance, at least in the medium term at 15,030. Given the kind of a mixed elements that we start to see, or not so mixed, there's more bearish elements that we start to see on the daily chart, but the support level still holds on 13,990, which I have already defined last week. So we will actually turn neutral for now first, look between 15,030 and 13,990. If we have a 4-hour close below 13,990, then we may start to see a further push down towards 13,600 slash 340 level for this coming week, before there's a chance, once it hit this level over here, very similar to the SPX 500 and the Nasdaq 100, and as well as the Hong Kong 50 index, which is the 61 point, which all of them actually retrace close to the 61.8% retracement of the recent up move from their March lows. Okay, there potentially we will go start to see another leg of medium term up move to actually take shape for the German 40 index. All right. So all in all, right, if I were to sum it up for this coming week, is that we are now facing the risk of a retracement, a much more deeper retracement. Uh, to actually retrace the recent recovery that was seen in the respective indices lows, mid-March low, 14th of March to earlier March, depending on which index you look at it. Uh, but at the moment in time, we still do not see the start of a drastic 20% major corrective down move yet to actually take shape at this juncture on the major indices from a technical analysis perspective. So have a great week ahead, and I see you again in my next video. Okay, before we go over here, is that okay, I almost forgot. So this is my social media account where actually I tweeted very frequently every day about what's going on in the markets and what are the interesting things to look out for. Like I highlighted earlier about the rising US Treasury yield curve and how does it impact various asset classes. So do give me a follow to find out the mechanics of the markets and what's going on and the key things to look out for across the financial asset classes from a broad-based perspective. So you can actually follow me or just open a Twitter account. It's free. Then after that, once your Twitter account is set up, so you can actually follow me. Just type at Kelvin SC Wong, and just give me a follow and on the notification that you're able to receive my tweets in real time. So with that, have a great trading week ahead.